For many investors, the constant media noise is an unwelcome and unsettling distraction. This media noise often causes investors to act on emotion and with a short-term focus. Emotional investing is one of the great wealth destroyers. As a starting point, it's worth remembering that journalists work within tight deadlines, and their role is to translate complex and fast-moving news into something interesting for the general public. However, in the rush to meet deadlines, accuracy and detail are often left behind, and the traditional media is now under intense pressure from the social media. Many people often forget that mainstream commercial media is a business, with the objective of making a profit for their shareholders. The profits are made through advertising, and to do this, they need an audience. The bigger the audience, the bigger the advertising, the bigger the profits. And to get an audience, you need to have eye-catching content. But the problem is, content's not cheap, with staff, rent, travel, and equipment costs. The role of the media is changing, and the traditional media is under attack, with both the general public and the advertisers deserting the mainstream media. News is now a commodity. It's free, real-time, portable and interactive. There are millions of self-made journalists on the internet. This has led to the mainstream media focusing on instant headlines. And one of the most common is the forecast or prediction, which is cheap to produce and grabs a headline, which inevitably is wrong. Unfortunately, the media noise often causes investors to respond to news that's already priced in the market, to act on media forecasts, or trying to time the market, or chasing past performance, or failing to diversify your investments, or ignoring costs and taxes. These behaviours are great wealth destroyers. Various studies across different markets overwhelmingly demonstrate that investor behaviour has a serious impact on potential return which you actually achieve. The Dalbar study, which is shown here, is regarded as one of the most thorough studies undertaken, and showed that between 1987 and 2007, the S&P 500 returned 11.81% per annum. That's the top 500 stocks in America. The average investor over the same period, however, achieved a return of only 4.48%. The market return is there for the taking, but the average investor has underperformed the market. Here are the results of two other studies, one in the US and one in Australia, which demonstrate disturbingly similar results. Trying to time investment markets is impossible, as the table shows. In summary, it's worth remembering that markets price news instantaneously and are forward-looking. The media is good at telling you what has happened, and your best protection remains diversification, discipline, and taking only those risks which you understand. Good luck. If you have any questions, don't hesitate to contact us.